With dozens of stock picks coming at you every single day, how do you know how many stocks to buy? How many stocks should you own in a portfolio for that highest possible return? In this video, we'll look at the research to reveal the optimal number of stocks to own and how to make getting those returns as easy as possible. We're talking how to start investing today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, one of the most frequent questions I get here on the channel, and more important than you might think, is how many stocks should I own? What's the best trade-off between spreading your money across multiple stocks and focusing on just a few for those higher returns? Now, it's a question that even a lot of experienced investors get wrong. You're sitting there maybe spending an hour or two a week watching videos or TV on investment ideas. Even investing in just a couple of those new ideas every single week, you can end up with a portfolio of hundreds of stocks very quickly. The problem here is that while too few stocks are going to leave you dangerously exposed to the ups and downs in any specific company, having too many stocks completely saps your chance of getting higher returns. You're just too diversified across so many stocks that your portfolio barely budges when one takes off. For example, if you own 50 stocks with an equal 2% of your portfolio in each, even if one of those stocks doubles in value, you'll still only see your total portfolio rise by 2% on that stock. There is a fine line between being protected from scandal or risk in any single stock to having too many stocks and not being able to get anything but a market return. So in this video, we'll look at the research on that optimal number of shares to own. Then I'll reveal a strategy that I use to get the best of both worlds. I'll show you how to get that diversification you need to protect your portfolio, but also the higher returns to beat the market. I'll show you how many stocks to buy, plus how much to invest in each stock. Now, how many stocks the average investor owns has really changed over time, and I think this really speaks to a problem in the market. Research by Bloom and Crockett in the early 70s found that a third of investors held just one stock, and half had two or fewer stocks in their portfolio. Now, more recent research from the Federal Reserve shows that the average investor now holds upwards of 30 stocks in their portfolio. So we've seen that shift from investors maybe holding one or two stocks, usually their employer or maybe a popular company, to investors now holding 30 or 40 companies in their portfolio or even more. And it's because investing has become an entertainment industry. Of course, holding just one or two stocks isn't good for investors either, because it means being wiped out when one of those companies falls on hard times. The problem with that 180-degree shift, though, is that holding 30 or 40 individual stocks means you're probably not doing the research you need to on any of them. You're spending maybe an hour max to look at the company, digging into its financials, and you're probably not able to keep up to date on the news and those earnings reports for every stock in your portfolio. Even if you're able to do this or trying to do this, really tracking an investment like you should, you're spending 10 plus hours a week following your stocks. This is the transformation of investing into an entertainment industry where the pundits on TV and online are just more interested in vomiting up as many stock picks a day as they can, confusing you with as much conflicting analysis as possible, and just keeping you chained to the market. Investing is no longer about making you money. It's about keeping you entertained and keeping you trading so brokers can collect commissions and fees. Now, enough of the rant, and don't get me wrong, I love that investing is accessible to everyone. The growth in the investing public over the last few decades has helped narrow that savings gap, but it's also come at a cost of almost too much information. Now, one of the ways I get around this information overload in stock picks is I'll add a stock to my paper portfolio in the Webull app first before investing real money in it. I can use the Webull simulator to follow a stock or test out a strategy and then put real money behind the best picks every few months. Now, I'll leave a link to Webull in the description below if you want to learn more about how that stock simulator works. Now, when we look at the actual research on how many stocks to own, and most of this is built around the idea of a minimum number of stocks that you need to be completely diversified. So the least number of stocks you should own in a portfolio so that your wealth doesn't jump up and down too much from just one single company. The most famous of these is by Evans and Archer, published in the Journal of Finance in 1968, and they found that you can get as diversification and spread that risk around in as few as 10 stocks. Now, understand an important part of this was the idea that these were all randomly picked stocks. Now, it's important because if you're consciously picking stocks based on factors like price to earnings ratio or maybe dividend yield or whatever, you're more likely to end up with companies that have common characteristics. Maybe you end up with 10 stocks from just one or two sectors of the economy, or maybe you end up with a narrow group of tech stocks if you're looking for that growth. In that case, that you would need more than that 10 stocks because you'd need to make sure that you have investments in different themes or different sectors to balance this out. Now, another popular study was done by Meyer-Statman in the Journal of Financial and Quantitative Analysis in 1987, finding you need at least 30 stocks for that minimum level of diversification. Now, there's other research, but the consensus seems to be right around these two. Between owning 10 to 30 stocks is that right level. This is where Benjamin Graham recommends with pretty much the investing Bible, The Intelligent Investor. In fact, Warren Buffett holds a little more than this, 43 stocks in his Berkshire Hathaway portfolio, though they are grouped right around just 7 of the 11 sectors. The problem is if you're looking at holding 20 or 30 or more stocks, we're right back to that problem of time. So unless you're a professional investor doing this around the clock, you don't want to be spending more than a few hours a week following stocks. Believe me, folks, it's just not worth it. You want to be enjoying your time with your family or whatever you like to do, not slumped over some cash flow statement trying to pick stocks. With 20 or 30 stocks, considering you need to read through the earnings reports and financials every 3 months on each, it just isn't realistic for the average investor. Now, that's why I use a strategy called the core satellite approach. This is where I invest in 8 to 10 individual stocks and then 3 to 5 funds. So with about 70% of my portfolio in those funds, that's all the diversification I need. I get exposure to hundreds of stocks, bonds, and real estate companies, so I'm covered on every part of the economy. Now with the remaining 30% that I have in those 8 to 10 stock picks, I get the opportunity for those higher returns. I've got 3 to 5% of my money in each, so I'm not overly exposed to problems at any one company, but I still have a chance to pick some strong stocks that are going to do well. And that last part is very important, so I want to repeat it as a point. You should never have more than maybe 5% of your money in any single stock. The problem here is that investors just get too overly excited about a stock. They put a bunch of money into it and maybe the shares fall a little bit, so the investor buys more shares in that dollar cost averaging strategy. They keep adding more shares and pretty soon you've got one stock that is 20 or 30% of your portfolio. What happens if that company bankrupts? Even if it doesn't though, where is your portfolio going if that stock is just dead money for years? You have got to keep a limit on the amount you have in any one single stock. I like to keep mine at no higher than 5% of my portfolio. You might decide a little higher, a little lower, but I'd keep it right around that area for that protection. Another way to think about this question of how to invest or how many stocks to own is investing in one specific sector for your individual stocks while getting your market diversification through ETFs, a group of funds. Now, a lot of investors are really surprised to hear that this is how Wall Street actually works. Professional analysts cover maybe one sector or industry or even only a few stocks. It's where they have that deep professional experience. So you've got a lot of pharmaceutical researchers or doctors that become analysts for healthcare stocks. You get engineers that become analysts on tech stocks. Most analysts don't try to pick stocks from every single sector, so why are you trying to? Now, a healthcare analyst doesn't try to pick tech stocks because they really just don't have that deep experience that's going to help them pick better companies. This is what Peter Lynch meant when he said invest in what you know. It's not about investing in the products that you know or like. It's about investing in the sectors or the companies in which you have that deep professional experience. So instead, why not get your market diversification through just a few funds, get that exposure to the stock market, bonds, and real estate, then put your experience and your knowledge to good use by picking the very best companies in just one industry. So for example, if you work in transportation, this means learning everything you can about what makes a good transportation company. Then of those companies in the group, you find those with a competitive advantage. You already have some professional experience in that sector or a specific industry, put it to use and invest in maybe 3 or 5 of the best companies in that group. You've got that market exposure and the diversification with the fund investments, with those ETFs. Maybe 3 to 5 ETFs that hold hundreds of stocks, bonds, and real estate. And then on top of this, you've got that upside return potential from being able to spot really the best of the best in that one sector or industry. Not only is this strategy going to help you pick better stocks, it's also going to make you an asset to your own job. You're learning what makes a company successful in that industry, in your work field. You're setting yourself up for a management position and to make more money. Click on the video to the right for my favorite 5 low-risk investments that not only protect your money, but will also grow your dough. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.